Hello, everyone. Good morning. Thank you for joining us. So, today we're going to talk about oil. So, the presentation will be divided into two parts. The first part would have the history of oil and how, the oil economy has evolved. And the second part would have more of the investing aspect, right? I'll get started with the first part. Right. So the 20th century has been called the century of oil, right? So back in the early 19th century, the US already knew about the existence of oil, except it wasn't technically mined as such, like how we know it today. It was just, collected from wherever it could be, um, it like even like a small puddle, right? And at that point there was no electricity, so lamps were used with and they were just stuffed with things that could burn, right? And there was also this interesting thing called the rule of capture, which says the first landowner to extract oil from the land would acquire the absolute ownership of that material, right, of the oil. And this holds true even if it were drained from another person's land. So technically, someone could go underground, go to the small parcel of another person's land and extract oil from there um, to their land and extract it out, right? And that would still be a legal method under the rule of capture. So it was at this point that the first oil well was dug by a person called Edward Drake in Pennsylvania. So this was in 1959, and this well, the first oil well was around 69 feet deep, right? And it was also at this point where kerosene was invented, right? So as everyone started using using kerosene, it created somewhat of a guaranteed demand for oil, right? And so after the first oil well was dug in Pennsylvania, very quickly, a lot of other states joined it, right? And this had a big impact because it was a growing market, it was an unregulated market, it was a market with a lot of players and a lot of supply as well. And this is where John Rockefeller came in. So at this point, John Rockefeller was a meat and um, vegetables trader. So he was basically an agricultural trader. He was an agri guy, and he also had a business partner with him, right? So business was going well. He was also quite enterprising as a person, and this was when the Civil War broke out, right? The U.S. Civil War, and his trading company, they started supplying materials to the army. And at this point, he already had like an eye on kerosene. And after the Civil War, his company had done very well, and he had also made a new acquaintance with Samuel Andrew. So Samuel Andrew was a chemist, and together, John Rockefeller, his business partner, and Samuel Andrew, in the early 1860s, um, launched the launched their oil business in Cleveland. Right, so they both mined and processed oil. They sold it to homes. Then they bought a couple of oil wells in Pennsylvania. Right, so Standard Oil, Rockefeller's company, was one of about 30 companies in the industry, right? And he was very cost conscious. He was very, you know, economically frugal. And this was why Standard Oil prospered to such an extent that they began to buy out their competitors, right? And by around 1872, Standard Oil controlled all of Cleveland's refineries, right? And this enables Standard Oil to negotiate better pricing in terms of transportation, right? And they not only, negotiated for a higher cut in the rebate than other producers, but he also negotiated for a share of the competitors. So he was not only increasing his profits, he was decreasing his competitors' profits as well, right? And Standard Oil also acquired pipelines and terminal facilities in other cities, and um, and expanded very quickly in the United States and abroad, right? And created a board with trustees. So the first major U.S. trust, and um, and a pattern for monopoly was actually set by Rockefeller and Standard Oil, right? And he also pioneered this concept called vertical integration, where one company controls multiple aspects of production, right? So with Rockefeller, it was leases, exploration, production, sale, processing, refinement, all of this, right? So if you want an example for vertical integration today, you can think of Apple, right? So you have hardware, software, a large portion of sales, after sales, right? So it was something like this, but as a monopoly in Rockefeller's case. So coming to 1911, right? The U.S. Supreme Court recognized the monopoly, and Standard Oil was split into 7 companies, right? So, and a lot of these companies, most of these you might well know now. So these were actually derivatives of Standard Oil, right? So if we see now, Standard Oil of New Jersey and New York, and this other company owned by Standard Oil called Vacuum Oil, right? This is now ExxonMobil, right? So all of these companies are owned by Standard Oil. So if you see Standard Oil of California and Kentucky Oil, which was again owned by Standard Oil, just not called Standard Oil, right? This is now Chevron. And very interesting part, Saudi Aramco is not owned was not owned by Standard Oil at that point. It was a joint venture between the Saudi government and Standard Oil of California, right? And Saudi Aramco was fully taken over by the Saudis in 1980, right? So this is the only outlier, kind of. I mean, it was a joint venture and not a direct ownership, right? And Marathon Oil was owned by the Ohio Oil Company, which is in Cleveland, and Standard Oil owned all of the oil refineries in Cleveland. And they acquired Transcontinental Oil at in around 1930, and they renamed it to Marathon Oil in 1962. Right? ConocoPhillips was again acquired by Standard Oil in 1884, and they were owned by DuPont until 1952. And they were owned by DuPont starting 1952 until 1999. And they merged with Phillips, and that's how you got ConocoPhillips. And that happened in the early 2000s. So to close out our Standard Oil and John Rockefeller's chapter here, let's look at this quote. So the secret to success is to do the most common things uncommonly well, right? And this is something I really like because it's similar to what most successful investors also follow. So basically, you don't need to be, or you don't need to do the most super extraordinary thing to be a successful investor, right? You just need to do the basics better than most of the market and most of your peers. So if you get if you have that emphasis, and if you just follow the basics right, you are already halfway there, or three quarters of the way there even, right? So yeah, that is something that we like. Okay, so now let's look at the other giant, which is OPEC. So in the early 1960s, right, Western oil companies, which is basically US, Canada, UK, and yeah, so they were basically cutting prices. So the Middle East was kind of frustrated by this, and in September 1960, like the six largest oil exporters in the Middle East, met to form the OPEC. Right? We know the power that the OPEC holds today, but initially, when they were first formed, and I think till like even a decade later, they were largely ignored by the US. So on June 1967, right, Israel entered into a war with Jordan, Egypt, and Syria. And your Middle Eastern Arab oil ministers, they called for an embargo to be placed on countries friendly with Israel, and your oil shipments to US and Britain stopped. But the US, however, sees very little impact by this because basically they increased their domestic production, and the embargo was anyways lifted in September of that year. Right? And in the 1970s, the OPEC refused to allow foreign companies to deal with the entire bloc as a whole. So they split the bloc into two, right? One for the Persian Gulf and one for the Mediterranean. And basically, if you want to buy oil from the OPEC, you have to negotiate with both of these blocks separately and arrive at a price, right? And this led to higher prices immediately, right? And within a decade, many of OPEC's members, they started nationalizing, either partially or fully, right? And this brought in a greater influence of the countries in price setting, right? And by the end of the decade, international oil companies had access to only 7% of the world's reserves, right? This was the end of the 1970s. Whereas in the 1960s, they had access to around 85% of the reserves. So this was, again, a huge hit for the rest of the world. And OPEC was growing at a very fast pace. On October of 1973, you had Syria and Egypt attack Israel again, right? And the US announced an aid package to Israel. And in response, again, you had another embargo, right? The Arab nations halted supplies to countries supporting Israel. And this led to shortages and, panic in a lot of, international countries, not only the US, right? And the second embargo was lifted in 1974 with the US agreeing to help in diplomatic relations between Egypt, Syria, and Israel, right? But what was different this time was this year, the top economies in the world, right, met to form the International Energy Agency, which we now know as the G7. It was called the G6, then it was the G8, and now it's the G7, right? Um, and again and again during the 1970s, right? This was in 1979. Um, so your oil ministers of the OPEC met for a summit in Vienna, right? And they were taken hostage, led by a Venezuelan terrorist called Carlos the Jackal and six of his accomplices. And again, this was um, related to the Israel-Palestine conflict, right? They held them ransom with, calling for the liberation of Palestine. And when we move to the 80s, right, in 1981, um, Ronald Reagan, who was then the president of the US, fully deregulated crude oil prices, right, allowing US producers to raise their prices to market levels. So your non-OPEC production at this point grew much faster than OPEC's production, and this impacted OPEC's pricing power, right? So global demand dropped over high prices, right? And this obviously increased, the saving of oil, and this led to another surplus, right? So the US responded by reducing imports to nearly half. And again, automobiles increased their efficiency, and consumers switched fuels for heating and electricity. So it was at this point you started looking at alternatives for oil, right? So from 1981 to 86, right? Oil prices dropped from $35 a barrel to around $15 a barrel in 1986, right? And the early 1980s also saw a period of stagflation. So you had the Iranian revolution, right, which resulted in another supply constraint, right? And this increased prices again across the world. And it was at this period where, unemployment rates were high, and inflation was already high. So it was a double whammy in an already recessionary environment, right? And when oil prices increased at this point, this exacerbated the existing recession, right? And interest rates were increased even higher. So this sort of a tough period ended somewhere between the second half of 82 to early 83, right? So again, in 1989, there was an oil spill that happened in Alaska in the United States. And this spill had 11 million barrels of oil involved, and this was one of the worst environmental disasters in US history to this day, right? And the cost to clean this up was around $2 billion. Again, so after this, in the 90s, the US Congress passed the Oil Pollution Act, and this established a sort of a trust fund for similar cases, and created response plans, gave guidelines, and capped liability for the offshore facilities. So if we move on a bit further to 2007, the US Congress passed the Energy Independence Act. So this increased fuel efficiency standards from 27 miles per gallon to 35 miles per gallon, and also mandated greater production of non-corn based ethanol, and also required biofuels blended with petrol to be at least 20% less polluting than actual petroleum, which was being used at that point, right? And in May 2009, the uh, standard for cars and light vehicles, which was 39 miles per gallon and 30 miles per gallon respectively, was announced. And again, in the 2000s, or rather in the 2010s, in this case, um, you had the Paris Agreement signed, right, where nothing was enforced as such, but there were periodic performance reviews, right? So to give the nations signing the accords some sort of accountability. Now let's look at a few wars fought over oil. So we all know about World War II, right? Why it was fought and such. But Germany's invasion of Russia might have had another underlying motive, right? So as the war progressed, Germany found it increasingly difficult to gain access to oil because the British Navy was, blocking their oil supply. So Germany invaded Russia because obviously there were differences in ideology, but they also wanted access to Russia's oil wells in the south side of Russia. And you had Iraq's invasion of Kuwait in the 90s. So this happened in 1990, and it was argued that Iraq wanted to curb Kuwait's oil production and, bring up prices to repay the debt that they amassed and had to refund um, while they were involved in the war with Iran. But the actual excuse given by Iraq was that Kuwait was stealing its oil through slant drilling, which is, again, if we go back to the first slide, you'd have seen, the rule of capture. So this is something similar to that. Iraq accused Kuwait of stealing oil through, slant drilling. The US-Iraq war was another interesting event. This event spanned over 5 years, right? And as you all might know, this resulted in the overthrowing of Saddam Hussein's government. The rationale given by the Americans was that Iraq was hiding weapons of mass destruction, right? And post 9/11, there were obviously a lot of jitters, and the US felt like they were posing a threat to, the US and its allies. This wasn't, the rationale was there because in the previous war with Kuwait, Iraq did use biological and chemical weapons, and they did, give the impression that they held weapons of mass destruction. But then again, Iraq was a very large player in the oil market with many, strategic reserves of oil. So finally, the South China Sea dispute. So China has been involved in disputes with Vietnam, Japan, and Taiwan over a few islands in the South China Sea. So the claims that China makes today is that is that the maps state that there's a clear border, right? But these maps were drawn hundreds of years ago. But some reports again state that China is actually claiming these islands because of the many um, you know oil beds under the surface, right? And some reports actually state that the oil beds in the South China Sea um, uh, contain as much material as Saudi Arabia's reserves that they hold right now. So with this, Samyuktha will take over the presentation. So Sam, you can start.
Thanks, Roshan. So I think Roshan has walked us through a large part of what happened in the 19th and 20th century in terms of oil. So this is about the eras of the 21st century, right? So this is a chart from a BCG presentation, and essentially they were looking at the US oil industry split into four distinct eras in the 21st century. So if we look at between 2004 to 2010, that is what they classify as the first era in terms of the supply constraint era. So essentially, during this phase of like 5 odd years, you had limited oil supply. There was a lot of OPEC domination in controlling what the prices were, and because oil prices were high, the ROCs for oil marketing companies were really great at this point, and that's reflected in the performance numbers also. If you look at the S&P 500 versus green energy versus oil and gas, and also the performance of Brent as an asset class. So while oil prices were rising, obviously the response from most countries was to start investing in their own energy independence. And Roshan briefly touched upon that as well in terms of what kind of laws were passed and how they got implemented. And so around 2008 to 2010, even though we're still looking at that first era, that's when companies began investing in expanding their capacities. So your capacity expansion basically happened from 2011 till about 2016, right? So this also led to the start of the shale boom, which was a secondary source of energy in the US, and that has largely contributed to the US's energy independence because until that point they were heavily reliant on oil. And even in recent years, whenever oil prices themselves have gone up, the US has been able to manage their requirements by producing more shale, right? So this is something that began in the late 2000s. And so naturally, as oil became cheaper, the ROCs for oil marketing companies also came down, and oil prices also dropped in this period. So you can see that Brent, which had gone up by 17% in the first era, had actually reduced by 16%. So in response to this falling price on Brent, you had OPEC respond by also reducing oil prices. So they didn't stop production; they responded through lower prices. So now again, when we come back to how OPEC functions, there's a lot of talk about how OPEC is a cartel, but it's not really that effective because there are so many individual players, and while they might sign on to something, individual players are still incentivized to not maintain production cuts. At the same time, you have parties that are outside of OPEC that are not really bound by these production cuts. So then external parties kind of capture the market when oil prices are either too high or too low. So then we move on to the third era, which is from 2016 onwards. And this is a key year because 2015 was when the Paris Accord was signed. There was a lot of commitment towards green energy. And while all of this was happening, I think this was the era of greening, which is basically companies investing in greener technologies like wind and solar, and that has become a trend, and that's also still playing out today. 2016 to 2020 was basically that period, and 2020 became our pandemic year. So there was suddenly very little demand for oil as countries went down into lockdown. So oil prices actually crashed. I think at one point during the pandemic, there was a lot of talk about how people were actually in the US, they were paying someone to come and take away oil because there was no place to store it, right? So that was so your oil futures actually went negative in that sense. A landmark moment. But then 2021 you had the Ukraine war, and oil prices shot up drastically after that. Then there were sanctions on Russia, and Russia could so a lot of Western countries were no longer buying oil from Russia, but Russian oil was so cheap. So countries like India benefited from that. You also had this indirect routing of Russian crude to even Western markets through either China or your Middle Eastern counterparts. So this era was basically the energy trilemma era, which is from 2020 till today. And the trilemma is basically countries suddenly realize that they have to balance their priorities between keeping oil affordable, also securing their energy requirements, and having sustainability in the focus at your forefront, right? So, in terms of sustainability, oil had always had a bad rep in terms of not being very environmentally friendly. But when the Russia-Ukraine war happened, Europe suddenly realized that they were heavily reliant on Russia for oil. A lot of their energy requirements were actually coming from there. And if you look at the news as to what is happening in Germany, you're seeing that they're reopening coal plants which were shut down a few years ago, because it's no longer just about sustainability. There is also this angle of having access to affordable fuel, which incidentally is why inflation has been spiraling out of control in the West, right? Because that has had cascading effects. It's basic commodities that have contributed to that inflation spiral. So this thing of balancing sustainability and affordability is there, but also having security in the sense that you don't want to be reliant on one partner. And this works both ways, right? Since Russia was largely importing to Europe, suddenly with the sanctions, they had to find other counterparts to trade with. Europe, they realized once relationships with Russia were not going in the direction that they wanted, the rest of Europe wanted to look at other ways of sourcing their energy requirements. So this is broadly how the 21st century has been from a US perspective, also from a perspective of policies in these years. And now we look at a tale of prices, which is essentially showing us how oil prices do react to actual events in the world, right? So I've just taken this chart from 2022 January until today. So if we look at 2022 January, your oil prices were below $80 per barrel. That's fairly cheap, especially because at that point inflation was picking up. And then you had this huge spike in February 2022, which basically happened immediately after Russia invaded Ukraine, and that escalated. And oil prices went to about $120, $130 per barrel at their peak price. This is just your price on that day. It's not the highest price, right? And then as it looked like things would sort of settle down, so you had a period of maybe 2 to 3 months where there was a lot of uncertainty on how this whole Russia-Ukraine situation was going to unfold. There were sanctions on Russian oil. There were Russian assets had been frozen. That I think you had the same thing happening in China, because they realized that countries that were not invoicing in the Russian ruble could now invoice in the Chinese yuan. So there was a lot of uncertainty on how this was going to play out. And I think by the time we got to July 22, Russian oil was in circulation. And then you can see a sort of steep decline in oil prices from July to October 2022. So again, you were back at the start of the year price, roughly at around $80 per barrel. And then OPEC issued production cuts, right? So they decided to cut production of oil by about 2 million barrels per day. And this continued for some more time until we got to April 2023, where again they announced further cuts. So from 2 million barrels per day, it became cumulatively about 3.5 million barrels per day. And this was supposed to go on until September. And then again in June 2023, they announced that these cuts would continue into 2024. So you can see that oil prices continue to rise, and there was an expectation that from September oil would become more and more expensive. And if we just look at how oil was this month alone, right? It's not so visible in this chart, but we started out the month close to like $97 per barrel. And there was a lot of speculation about oil going to $100 per barrel. And that kind of reduced as soon as US economic data came out, indicating that, things were not as rosy as they looked. And so then there was speculation that oil demand would lower, so then the prices fell. And then immediately after that, like within a few days, you had the war in West Asia break out. And a lot of oil demand is contingent on China's growth now, because China is a large consumer of oil, and depending on whether their economic health indicators look positive or not, is going to have a big impact on what the oil demand is like globally. So one thing that's pretty clear is that if we look at the price of the oil, we can clearly tell what is happening in the world. We can clearly correlate the movement on day-to-day basis with events that are happening. So one of the key worries was about peak oil, right? And peak oil is this idea that at some point we're going to reach the maximum possible production of oil. And when we do that and we're still reliant on oil for our energy requirements, then we're going to have a really tough time being sort of ahead of the curve in meeting what we require. So the first predictions for peak oil were in 1950s, where they thought that we would reach peak oil production in the 1960s, sometime between 1965 and 1971. And in 2000, obviously we didn't reach peak production, and I'll give you some statistics. So in the year 2000, we were producing something like 12.5 billion barrels of oil per year. And now about 22 years later, in 2022, our oil production globally is almost 3 times that number at 34 billion barrels, right? So today, the most recent predictions about when we'll hit peak oil, and so again, this contributes to the dilemma, right? Like we need to have sustainability. You know that this is a limited natural resource. You can't renew it in that sense. It's a source of energy. So given that, I think in our predictions for today range anywhere between 2025 and 2040. So it's a very, very wide range about when we're going to hit peak oil and how fast we need to move towards other sources of energy so that we are more sustainable in terms of managing our energy requirements. I think towards this effect, like the antidote has been to go green, and these are charts from a McKinsey report. So if you look at what peak demand is, not peak oil. So peak oil is more on the production side. So peak demand again varies quite widely, right? So the expectation is that before we hit 2030, at some point we're going to peak in terms of demand for fossil fuels alone. But if you look at the range, you could have almost stable requirement in oil from 2030 to 2050, or you could have a steep decline. That's what the light blue area shows us, right? So it's not the most important thing being that fossil fuels aren't going out of the picture anytime soon. While we are in that era of transition, it doesn't mean that it's going to happen overnight, and we're still not yet at peak demand. So we have to hit peak demand, we have to hit diversification, and then you'll see a decline. So how that's going to happen is still anybody's guess. The chart on the right really looks at, sorry, Roshan, can you go back? The chart on the right looks at how renewables are projected to make up a bulk of the mix by 2050. So this shows you how we're going to get from where we are today to where we're going to be in the future. So if you look at the line that says fossil, right, most of our demand today is really in this section. And then you see maybe nuclear energy and hydro as well as solar picking up in the next couple of decades. All right, next slide, please. So why are we talking so much about oil? Because after all, our presentation is how it affects your investment choices, right? So there was an RBI paper which was published, and the key findings from this paper were that one is that this can be a crude shock, because if your oil prices are out of range and the RBI's projection is at $85 per barrel, and we've been above that number for the large part of this month, then your CAD to GDP rises regardless of growth. So a lot of conversation about, oh yeah, we are at higher oil prices, but we're also growing really fast, and our current account deficit has been in a great spot. All of this kind of takes us back to the drawing board and shows us that this metric can still rise regardless of how well the economy is doing. And when it does rise, if you have a larger current account deficit, then that automatically has an impact on yields, on the cost of borrowing. It can trickle down into your currency valuations as well. And in terms of the two other findings is that for every $10 increase in crude oil, there's almost a 0.5% increase in inflation that corresponds with this. And similarly, for every $10 increase in the price of crude oil, you're going to have almost a 0.4% impact on your fiscal deficit. So the math is pretty clear. If you have a wider fiscal deficit, you have a higher current account deficit, then it's going to impact your yields, it's going to impact your currency. So then moving on to what your investment options are going to be, right? If in this scenario, as we get to high inflation, we need to understand that your profit margins are going to get compressed. So if you're looking at specifically smaller companies that have a lot of raw material inputs, then you need to be aware of the fact that their profit margins are going to get compressed. Whatever analysis you're doing or projections that you're making based on those inputs are going to vary quite widely from the past couple of years. The second important impact on the investment sides is that with high inflation, people look at inflation hedges, and these include investments like commodities and store of value assets, which also applies in the event of rupee depreciation. So what we've seen this year so far in gold is that while gold prices have varied quite a bit on a global level, at the INR level, you're not seeing too much traction there. But in eras of high inflation, eventually it is store of value assets that do tend to outperform. So that could be things like precious metals, it could be things like real estate. All of these are tangible assets which tend to outperform when money loses value per se. And the fourth one is rising CAD, which is basically what I talked about earlier, which is as your current account deficit widens, then your yields also become more volatile. When your yields for the government securities at the 10-year level become more volatile, then your cost of borrowing also goes up in different elements. And the last point is that if you're in an era where you have higher inflation, if you're in an era where you have volatile oil prices with an upward expectation of where oil prices are going to head, then you need to also moderate your growth expectations. So the idea that, okay, India is the brightest spot, all of that, somewhere we need to temper our expectations a little bit if oil goes out of control. And today the scenario is such that you can't really be sure where you're heading. And I think with that, we are done with the presentation. So do you have any questions? You can type it in the chat box and we'll be happy to take it and get back to you. What do you mean by, what does it mean in numbers for India in terms of yearly imports? I'm sorry, I'm not sure I understand the question. I don't think anyone really benefits from high inflation, right? You want inflation to be at a good level, which is not too much. So our band for comfortable inflation is somewhere between 2 to 6%, with 4% being a better number than either 2 or 6%. And given that, like, I don't think you can benefit because if your cost of production goes down, there is only the question of how much can I pass on to the downstream consumer. And if you cannot pass it on, then you're kind of stuck because either your profit margins are going to get squeezed, or even if you can pass it on, then there might be a reduction in terms of volume growth, right? So both ways, it's not really a good thing. So having inflation in a band is better than looking at a high inflation scenario. I'm not sure about the exact number in terms of value, that is like how much we import, but it is a large part of our import basket, right? So amongst the two biggest things that we import are oil and gold. So those two prices are going to affect your CAD. They are going to affect pretty much anything that has to do with your import or export data.
For the value, I think it's north of 150 billion in dollars. $150 billion.
So inflation hedges are anything. So commodity-based investments, you have gold and silver. These would all qualify as inflation hedges. So ethanol blending is still in the early part, and that is only for vehicle usage as of now, right? But oil has other industrial uses as well. So uh, it's going to be a longer journey. Like again, like I said, this entire transition to greener or mixed energies is not like a story that's going to be 1 year or 2 years. Like you have to have policy, then you need to have implementation, then it has to meet regular use. Then people need to switch to a newer form of energy. All of this takes time. It doesn't happen overnight, and we are still in the policy phase. We'll just give it one more minute in case we have any other questions, and then we'll close. Before we do that, we'd like to thank everyone for attending today. It's been really nice to do this session on something different, and we've had quite interesting questions come in as well. I think if you look at it broadly, you need to be more comfortable. I mean, you need to look rather than from a sectoral perspective. I think you need to look at companies which have had a vintage of being in the market for multiple cycles, because they would have, as you have seen, right, the oil price era itself, you've seen eras where oil has been steady, you've seen times when oil has risen out of control. You have seen lower oil costs as well. So if companies have only operated in an industry where oil costs have been stable or low, then this is the first time they're going to be looking at a scenario where oil costs are rising. So if you know that any sector where they're reliant on energy, any sector that is reliant on petroleum and petrochemicals, then all of these you need to consider the impact there. I think that will be the last question that we'll take. So thank you everyone. Do get in touch with us. These are our contact details. If you have more questions, if you want to talk to one of our strategists, or if you have anything else that you'd like to get in touch with our team, you could just message or call us. Roshan, can you take it to the next slide, please, so that they have access to our coordinates? Thank you.